Adobe just announced earnings last week. It beat on revenue, it beat on profit, it raised its guidance for the entire year. And then the stock crashed to its lowest level in 8 years. And of course, I'm down by more than 30% on the stock. Look at how they massacred my boy. So what is actually going on here? How does a company do everything right and still got sold off this hard? And what am I actually going to do about it? So let's not waste any time and let's get straight into it. Okay, let's start with the actual numbers. In the latest quarter, Adobe's revenue came in at $6.62 billion. That is up 13% from a year ago. Meanwhile, profit on an adjusted basis was $5.96 per share, up 18%. Both of those beat what Wall Street was expecting. And on top of that, Adobe raised its forecast for the full year to between $26.5 billion and $26.6 billion in revenue. Now, part of that growth actually came from SEMrush, which Adobe bought back in April. But even if you strip that out, the underlying business still grew revenue around 12%, which is still a little faster than the same quarter last year. So this was not a weak quarter that got dressed up, because the core business is still genuinely growing. Which brings us to the real question. If the numbers were this good, why did the stock still drop? It all comes down to 3 reasons, and they all stack on top of each other. The first one actually has nothing to do with the numbers. It is the people leaving. On the same day the results came out, Adobe's Chief Financial Officer, Dan Dunn, announced that he is leaving, not in 6 months, but in 4 days. He's going to become the finance chief at a chip company called Marvell, which is right at the center of the AI hardware boom. So he probably didn't quit because there was something wrong with the company. Instead, he just got poached by a hotter company. But the timing when he walked out in the same week as earnings, that's what spooked people. Add to the fact that this came not long after Adobe had announced that its CEO is on his way out too. Back in March, Chantal Narayan, who has run this company for 18 years, has announced that he's stepping down as CEO once they find a replacement. So when you put these two together, the company is changing both its CEO and its CFO right when it needs steady hands the most. And that doesn't exactly inspire confidence. The second reason came from the earnings call itself. During the call, Adobe said that it's going to push free AI products to grow its user base in order to get as many people as possible onto its tools. While that sounds like a smart long-term strategy, the downside is that it slows down one of its most important growth numbers, and it is recurring revenue. To be specific, Adobe cuts its own forecast for how fast the recurring revenue will grow in the second half of the year by about 2 percentage points. And that is not what investors wanted to hear. And the third reason is the most obvious of them all, and is that AI can now make images, designs, and videos easily. And this could eat away at the very thing Adobe sells. So even when Adobe posts a good quarter, the stock still fell because the market is still looking for proof that Adobe is able to keep its competitive moat. So those are the 3 reasons the stock hasn't been doing so well. Now, if you want to start investing, you need to keep your costs low. That's why I use Interactive Brokers. With Interactive Brokers, you are paying just 35 cents per trade on the US stock market. That's one of the lowest in the industry. They also give you access to Ireland domiciled ETFs, which can save you a chunk of dividend withholding taxes. And if you are not sure what to invest in, they also have a bunch of free company research tools built right into the platform. So you can do your homework before putting your hard-earned money in. Check out my link in the description to get started. Alright, now back to the video. But now, let me try to make the case as to why I think the market may be wrong about the company. The biggest reason I still believe in this company comes down to 2 words: switching costs. Those switching costs come from everything that's built around Adobe, from entire company workflows and team templates to brand libraries and years of customer data, which all live inside Adobe's tools. More than half of the Fortune 100 run on them under multi-year contracts. So walking away from Adobe isn't as easy as downloading a cheaper app. It's having to retrain your whole team and migrate years of work. And ain't nobody got time for that. And here's the proof people aren't leaving. Adobe's total recurring revenue is up 12.5% in a year. If customers were walking out of the door, the number wouldn't be growing. At the same time, its recurring revenue from core creative and marketing professionals grew by 11% over the year, while the number of enterprises paying Adobe more than $10 million a year also grew by over 20%. Additionally, its enterprise AI content tool, Gen Studio, grew recurring revenue more than 25%. And the AI tools Adobe sells to big companies to manage their customer experiences quadrupled. This means that the businesses with the deepest pockets are pouring more into Adobe's AI rather than turning away from it. And part of why they don't leave is the one thing cheaper tools can't copy: trust. And here's what I mean. Adobe's AI called Firefly is commercially safe, as it's only trained on images that Adobe actually owns and has paid for. This means that a company can use it without having to worry that the image is secretly copied from someone else's work. Meanwhile, other free tools like Gemini or ChatGPT can't make that promise because they were built by scraping whatever they could find off the internet. And if you're a giant brand like Nike or Coca-Cola, you are not about to risk a lawsuit just to save a bit of money on software. That right there is the moat. But here's the part the market is ignoring. Adobe's AI products are actually making money right now. And it's not just a trickle. The revenue from its new AI-first products tripled over the past year to more than $500 million. A year and a half ago, that figure was above $125 million. Then it crossed $250 million, and now it is past $500 million. That is a line that's growing quickly rather than flattening out. Meanwhile, Firefly is already pulling in close to $300 million in annual recurring revenue, while growing about 50% in a single quarter. But here's the move almost nobody is talking about. In April, Adobe launched the Firefly AI Assistant, an AI agent that lives inside Adobe's apps and does your creative work on command. And now, Adobe is building a version of it to run inside other chatbots, starting with Claude itself. So the very tool people feared would replace Adobe just becomes another place Adobe shows up. Besides that, there's also a couple of fears that are simply not showing up in the results. For example, people were worried that all this AI will wreck Adobe's profit margins because running AI is expensive. But at the core level, it isn't. Adobe's gross margin, which is what's left after the cost of actually delivering the software, is still around 89%. This is about as healthy as software gets. Sure, its overall operating margin did dip a little this quarter, but that's because Adobe is choosing to spend more to build up AI, and not because AI is quietly bleeding it dry. Not only that, people also fear that cheaper tools like Canva would eat Adobe from the bottom. Well, the fact that Adobe's very own Canva competitor, called Express, grew its users more than 20% in just one quarter, while its free user base crossed 19 million people, up more than 70% from a year earlier. On top of that, Adobe's AI assistant inside the PDF products more than doubled its paid users, and is also quietly running the oldest playbook in tech, which is getting students hooked while they are still in school, as its access through schools grew more than 60%. This is exactly how Microsoft and Google built their empires, where they hook them young and keep them for life. But perhaps the loudest bullish signal came from Adobe itself. If management really believed AI was about to eat the business, the last thing they would do is pour cash into their own stock. But that's exactly what they are doing. Last quarter, Adobe bought back 8.5 million of its own shares, with around $25 billion still set aside for more. So how cheap is the stock right now? Adobe currently trades at about 10 times its expected earnings. Its average over the last decade was around 44 times, so it's now roughly a quarter of its normal valuation. Michael Burry, the investor made famous by The Big Short, also disclosed earlier this year that he bought Adobe in the low 250s, calling its ecosystem a strong moat. Now, of course, this may not mean much, as Burry's long-term track record isn't that great, as he often gets his calls wrong. But it's still interesting that an investor known for betting against hype is buying Adobe for the same reason we covered, which is the moat. So those were some of the points for the bull case. However, it's just as important to talk about the bear case, because just because Adobe is growing today does not prove that you won't be disrupted tomorrow. And the people selling this stock have real arguments too. So earlier, I told you that Adobe pushing all those free AI products was a smart long-term move to grow its user base. However, if you look at it the other way, you could also say that this is a warning sign, because if demand was really as strong as Adobe claims, you wouldn't need to delay price hikes and lean on free users just to hit your numbers. Instead, you will charge more money. So the fact that they are doing it could also be because the company is quietly admitting that easy growth is behind it. And the longer trend backs the bear up. Adobe's recurring revenue growth has been slowly grinding down for years. Back at the start of 2024, it was climbing at almost 14% a year, but by the end of last year, it was down to about 11.5%. And Adobe's forecast for this year is even lower at just 10.2%. So while the total dollars still go up, the rate keeps getting slower and slower. This shows that as the core creative software market is maturing, growth is getting harder and harder to come by. And then there's also the scale problem. Yes, AI revenue tripled, but that AI revenue, the $500 million, is still less than 2% of Adobe's $27 billion business. So if anything, it's going to take a couple of years for AI revenue to actually move the needle. Then of course, the competition is real. On one hand, you have Canva and Figma who will keep winning users on the cheaper end. And on the other, free AI image tools from the likes of OpenAI and Google are making good enough design for almost free. So the whole bear thesis is simple. If AI makes good enough design basically free, then why would people keep paying for Adobe? So here's what I'm doing with my own money. I'm holding, but I'm not adding at the moment, even though the stock is much cheaper now. Here's why. The reason I'm not selling yet is because the business is still growing. It raised its guidance, it generates over $10 billion in cash a year, and is buying back its own stock. So my reason for owning this company has actually not broken yet. However, at the same time, I don't expect the price to recover anytime soon. That's because even if I'm right about the business, history often shows that the stock itself can take a long time to catch up. Take for example, back in 2022, Meta fell by 76% because everyone was sure that the metaverse was a money pit and TikTok was killing it. Meanwhile, the business was fine and it took about a year to fully recover. Then look at Netflix that same year. It dropped 72% on fears that competition would crush it. But this time, it took about 2 years to recover. However, it doesn't always come back quickly. One good example is Microsoft. After the dot-com bubble pop, it basically went nowhere from 2000 to 2013. On the other hand, PayPal fell 80% on disruption fears and never recovered. So while Adobe is cheap right now, cheap can actually get cheaper. And if you want proof that nobody actually knows what will happen, look at Wall Street itself. That same week, Goldman Sachs said to sell Adobe with a price target of $190, while JP Morgan said buy with a target of $340. There is a $150 gap between two of the smartest desks on the world on the same stock in the same week. When the professionals disagree that much, it tells you that this is genuinely unsolved. And to me, it's not a signal to act, but to wait for further evidence. Though, with that being said, there's one thing that does give me some comfort. Right now, Adobe's valuation has already collapsed from about 44 times earnings down to about 10. So unlike Microsoft back in 2000, which started off expensive, most of that painful repricing may already be behind us. However, in order for me to continue adding, two things need to happen. First, I want to see that the recurring revenue growth stop falling and turn back up. That's the proof that all those free users actually convert into paying customers instead of just being a nice sounding number. Two, I want a permanent CEO and a permanent CFO in their seats. I'm not going to average down into a company with two empty chairs at the top during its most important transition. When those two things happen, I will add. But until then, I will wait and see. So that was my review on Adobe. If this helped you, like, share and subscribe as I'll be posting new videos every week. And just remember, this isn't financial advice, it's my own money and my own plan. So thanks for watching and I will see you in the next one.